And I want to welcome you to our webinar today, Make Your Stock Plan, Audit, and IPO Ready. So we want to first just walk you through using your webinar pane. You'll see the orange arrow in the upper right corner of your screen. To pose a question, type in a question for our presenters today. Please just maximize that webinar pane and type in the question and hit send. And as time allows at the end of the webinar, we will run through those questions and get you answers for those. And then also, just to make sure that you're getting the best audio quality, if you're listening in on your telephone, please select the telephone button. If you are using your computer's mic and speakers, use that button, and that will eliminate any echo effect. And today is a CE, Continuing Education webinar. So to qualify, you must be using your personal computer and log in with your own information and unique URL. You need to be logged into our webinar for at least 50 consecutive minutes and actively respond to 75% of the polling questions. We also need you to complete the evaluation survey at the end of the webinar. All right, and I'd like to introduce our presenters today. First, we're going to start with Matt Peralt, a partner in our audit practice. And Matt heads up the SEC and technology practice for Armanino, and he has supported more than 50 technology sector transactions. He has 20-plus years of experience and has participated in numerous IPOs, mergers, acquisitions, private placements, and LBOs, both in industry and as an auditor. Scott Schwartz is our manager in our consulting department. He has been working with both public and private companies, and he also consults entrepreneurs. At Armanino, he serves clients in our equity management solutions practice, and he's conducted numerous stock and acquisition-related evaluations and worked with our entire portfolio of equity compensation outsourcing clients. And next is Amy Rochelle, a senior manager at Five9. She's our special guest today. She's providing a commentary on walking through this whole getting your stock plan audit ready. So her current role includes overseeing billing, collections, AP, purchasing, and stock administration at Five9. And in her career, she's also led 3 years of audits in preparation for S-1. Thank you. And so now during today's webinar, you will learn to recognize many of the risks and penalties involved in stock option accounting, utilize an audit readiness checklist, and review complexities of stock options and merger and acquisition transactions. Throughout the webinar, we're going to go over risks and penalties, how to be audit ready, how to utilize that checklist that we've got for you, tips for interacting with auditors, considerations you should have on mergers and acquisitions, and then IPO-specific readiness. And with that, I'm going to turn it over to Scott Schwartz.
Thanks, Mary. Welcome, everyone. Thanks for joining us. We're going to start with a quick overview of stock administration and kind of why it's important, why we're talking about it, and why it's difficult. One of the key reasons that it's difficult is because it stems across the organization. It hits your HR, your finance, your tax departments, legal. Many times outside providers, whether it be legal or consultants, are involved. And there's not a lot of reward for doing things right, but there's high penalties with the IRS, with participants, lawsuits, etc. when things go wrong. So, a lot of what we're going to talk about today is process and cleanup and trying to either start out on the right foot, or if you're already in the further along, to get back on the right foot. And part of that is balancing low-cost solutions versus risk. And one of the things that we'll harp on over and over today is timing. The importance of of doing things in the moment, whether it's certain types of accounting, whether it's administratively, whether it's getting a confirmation or a signature, doing things in the moment. And I know Amy is going to be kind of touching on that as well. And we'll get into our first case study here that touches on in the moment as well. So the background of the case study is that the company grants all new hires shares. So it's in their offer letters. It says that they're going to be granted. But the problem is that the board didn't approve these grants for certain new hires. So somehow, maybe it's years ago, maybe in this case it was years ago, but it could be recent. But we've missed 2, 3, 5, 10 people along the way in our history that we haven't granted shares to, but we said we're going to offer them shares. So some of the issues that come into play is how do we properly compensate these employees today when we've realized, hey, we've missed them, how do we compensate them? Our price has now risen, we may be closer to an exit event, etc., so there may be more value to those shares, so how do we properly compensate them? In the case study in this specific that we're referencing, the board and the comp committee met to basically make those employees whole. And if they had already terminated, it's giving them a cash settlement maybe, trying to avoid a lawsuit, or for the people that are still employed, granting them new grants at today's price. So I thought maybe, Amy, we could start kind of introducing you with your process in maybe uncovering some of these things that happened before you started, but now going through a cleanup process and getting ready for audits and S-1 filings. How your process has improved.
Sure, Scott. So what we have started to do now is we have one HR team member that actually puts together the list, and a second person in HR reviews that list. Prior to that, it was just one person. One other thing that I also want to start doing is to run a report out of our payroll system, because there are two separate systems. We use one for our HR database and then ADP for payroll. Run all the new hires out of that system as well, just to ensure we've captured the entire population. That still doesn't capture those people that got promotions. That is entirely HR dependent, but it would be 90% of your grants. We actually did have this issue at 5.9, and we bonused people the difference in the price. So when their original option should have been approved, it was 10 cents, and now when it did get approved, it was 50 cents. We actually gave them a bonus to try to make them whole from a cash standpoint for the 40-cent difference in the strike price.
Yeah, and I think that's a common answer, really, because you have to make them whole and avoid any legal action. So with that, we're going to go to our first polling question.
Great. So thank you, Scott. So the question is, how do you manage equity administration at your organization? Do you use a software tool, spreadsheets, and external consultants, or do you have another option? So if you can weigh in there, again, answering these polling questions does help you to get the continuing education credits for attending today's webinar. So we'll keep it open for another 30 seconds or so. Thank you. We've got a few people who voted in, and we're seeing a split across the responses. So we'll go ahead and close this poll in 10 seconds here. And all right, so thank you for participating. We'll open up the responses here and share that with everyone.
So it looks like more than 50% of you are using some sort of software tool, which is great. Definitely, we encourage that. I think that as early as you can start on a software system, you can hedge the cost to converting to a system later, but also mitigate some of the items that you might have missed, the cleanup necessities. One thing I will say, just to go back to the case study we're talking about, as part of getting ready for an IPO, and we'll talk about it later, but that review, that analysis of offer letters, board minutes, to actual grant agreements is an important step to make sure you capture everything. So now we're going to talk a little bit more on the administration processes, and I'm going to turn it over to Matt.
Thanks, Scott. So as Scott said, when you are administering a stock option plan, I imagine most of the folks on this call are finance professionals. And it may be the case that until the company is getting ready for an IPO, you have not been involved in accounting for stock options. Oftentimes it's just left to human resources and the upper executives to determine who is getting what, and they will coordinate that with attorneys to issue the plan. And so you're kind of coming in after the fact. And when you do that, it's important that you sit down, you read through the stock option plan, you understand what are the parameters of the grants. Is there any grants that have happened outside of what's written in the plan? And then in particular, what are the nature of the equity agreements that are being structured? Are they simply stock options? Are you giving away restricted stock units, phantom stock? It's certainly important to understand not just the instruments themselves, but then what is the practice that may be happening outside of what's written in the plan. If you're finding that the company is settling stock options in cash and that's not written in the plan, then that could force you into liability treatment, and that could cause you to mark all the options to market, which could result in a huge P&L swing any given quarter depending on where the stock price is going. So certainly, again, what we're emphasizing here is, as a finance professional, you shouldn't just be taking the numbers straight off of some reports and then going through them. You need some background. You need to sit down and read the plan, and you need to talk to the folks administering the plan if you're not involved in that component, so that you understand if there's anything going on that's not within the plan, because again, that's going to create some really sticky accounting issues.
Yeah, I'll just say we have a client that they have a repurchase provision in their grant. Basically, it's a put option for the participant. So at any time, they can have their grant repurchased, and like you said, that causes, in this case, causes liability accounting. So, and then we've come across some other ones I know you and I have talked about where the company's practice is just generally to repurchase grants in cash. Anytime somebody exercises, they're going to repurchase it in cash, and so again, you may end up with your practices, even though your plan doesn't say, but your practices may sort of imply that you have certain accounting impacts.
Yeah, and another sticky element there is if you allow early exercise of stock options and you allow the employees that are purchasing those options to do the exercise with a note rather than with cash. And then it really becomes dependent upon whether or not you intend to enforce the collection of that note. Could determine, again, whether you've got equity or liability treatment. So it's very important to understand practice versus what's in the plan. Okay, this next slide, we're talking about process and procedures. Certainly we recommend that a company would have procedures in place. They don't necessarily need a lengthy document description detailing each step. Really, this is a reminder or a checklist for the focal point in the finance organization to make sure that they're capturing all of these items, and again, it could be a very simple bullet point checklist, but it's something that you should be revisiting at the end of each month, likely, or at a minimum at the end of each quarter, so that you understand what are all the principles behind valuation, issuing grants, and anything in the way of exercises, terminations, or modifications. You need to sit down with basically everybody involved and walk through this checklist just to make sure that you're capturing the activity that's happened during the quarter and that people are following the policy as it's written. Certainly with companies that we're talking to on this call, we imagine a lot of you folks are getting ready for an IPO, so SOX readiness is a component. You're probably going to want to start taking those procedures that you may have been informal, putting them down on a piece of paper so that you're thinking about SOX readiness in anticipation of an IPO. And it's just an idea again about getting proactive before you start trying to book the accounting entries, because you don't want to be sitting down at the end of the year and all of a sudden trying to untangle a mess of things that have happened during the course of the year. Again, another big piece in determining the stock option expense is just how frequently are you going to get what's referred to as the 409A valuation. And as the company is approaching an IPO, the SEC common practice is to look back the last 18 months prior to the IPO. So certainly that's going to be your window when you're going to want to have valuations done fairly frequently inside of that 18-month window, probably on a quarterly basis. But even before that, for IRS purposes, you want to make sure that you have valuation done that's a qualified professional, and that it's got reasonable numbers in there so the IRS doesn't come back and challenge things. And again, just make sure that you're checking with your auditor. If the company has not yet engaged an auditor, just make sure that the 409A firm is somebody that's recognized and reputable.
Okay, next to our second polling question. And as we're pulling that up, I do want to remind you that if you have questions for our presenters, you can type them in at any time throughout the webinar, and we will get to those at the end. Okay, so which of the following equity awards does your plan allow? Are you at RSUs, phantom shares, stock appreciation rights, or you're not sure? So if you can weigh in and let us know which of the equity awards are included in your plan. And we've got about half of the group voted, so again, please put in your decision there so that we can get you that continuing education for today. All right, and we'll close it in 10 seconds here. All right, so thank you for everybody for weighing in, and we're going to open up the answers there for the audience.
So we've got about a little more than half folks that are issuing RSUs. I think if you'd taken the same survey 5 years ago, it probably would have been less than 15%. We're seeing generally more exotic instruments as stock options are being tapered down. RSUs is a good way for companies to reward employees that's not necessarily going to work against the employees or have no benefit in the event the stock stays flat. So.
Yeah, it's interesting that almost half of you, though, are unsure of which types of awards are allowed. So I wonder if that implies that we haven't read our stock plans, but definitely if that is the reason, then you want to go back and look at that. If you are granting something that isn't allowed by your plan, then you either have to do an amendment or potentially that's just granted outside of the plan, and you'll have different disclosure issues or items around that as well. Options, obviously, we didn't put that on here because that's the most commonly allowed instrument. So I'm going to walk through just some tips on issuing grants. Again, some of this may be straightforward, but oftentimes we find that the process, there's something missing in the process, and we talked about it earlier. Matt touched on having documented processes. Again, this may not be a manual necessarily, but some sort of checklist. Who's touching what, who's responsible for what, and it starts, as Amy was touching on, early in the process at the HR level, right? Making sure that an employee's offer letter, if HR is handling that piece, it gets passed to finance, and then finance puts it in the board minutes for approval. One of the other big items to be considerate of is the ISO limitations. And there's multiple ways to handle it, and I'll let Amy chime in on some of the ways that we've looked at or she's been through. But some companies ignore it. Some companies like to be explicit about it. But I think internally, as a finance organization, as your tax payroll people, you want to be considerate of those limitations. Definitely, as Matt talked about, 409A, deferred comp. The last steps are on the back end. So the board has now approved our awards. And we want to, again, we have the front end process, making sure all of our offer letter grants get into the board minutes. But now we want to make sure all of our board minutes actually get papered. All of our grants in our board minutes get papered and out to our participants. And then lastly, our participants accept those awards. Acceptance is a big piece that tends to be missing especially from earlier stage companies. That execution, that signature on the participants side. If you're using software, many of the softwares today have online grant acceptance, which is a great way to avoid A, paperwork, but B, having to track people down for signatures. But you want to have some sort of follow-up process. I know, Amy, you can speak to having to kind of go through now the process of getting signatures.
And so I have a few comments here, actually. One thing I would recommend is if you can get a draft version of the board minutes before they get approved. We've had a couple situations where even though the list was complete, that complete list didn't make it in the board minutes and they were approved incorrectly. So that has certainly helped us. We are using software for all of our equity accounting, but we don't do our grant agreements out of there quite yet. So we just started using DocuSign, which has actually been really slick. We're kind of looking at it as a Band-Aid until we are up and running full boat and issuing all grant agreements and have our broker up and running and all of that. But it's worked great, so I'd highly recommend it. And there was not a lot of implementation work to make that happen. And it's been very well accepted by the employees as well. They have an electronic copy of the signed version. They don't have to come back to the stock team and say, can you give me that now that both parties have signed, and all those types of things. In terms of the 100K limit, that has been an interesting one in terms of 5.9. We've kind of gone back and forth with how we've documented it. As our prices continue to rise, some of our executives, their grants, of course, part of it is an ISO and part's a non-qual. At one point, we were actually doing 2 separate grant agreements, and our attorney stance has now changed on that, and we are back to doing just 1 agreement with generic wording related to the ISO limitation. And we can get that out to you guys if you would need that wording for your use.
Thanks, Amy. And we're going to kind of dive actually a little bit deeper into the ISO non-qual limit. So Amy was just mentioning the $100,000 rule, and so what that is we can only have $100,000 worth of ISOs become exercisable in any calendar year. It gets more complex if you have early exercise shares, or if you have multiple grants, you have to consider all of those grants. But from an ISO non-qual, if you have any 10% owners, they have to have 110% of the fair market value as their exercise price. So that's something to be cognizant of. Really with non-quals, it's pretty free. You can issue non-quals to anyone, and they can be at any price, exercise price. Obviously the downside for participants is that they are taxed at ordinary income upon exercise. That's spread between the exercise price and the fair market value. And if it's a non-employee, you're going to have 1099 reporting for that non-qual, and if it is an employee, you'd have W-2 and withholding requirements. And then the company, if you're not, if you're not in a loss position per se, you can get that tax deduction at exercise. For ISOs, we can only grant those to employees, and there is, and it's becoming more and more of an issue now that our government's looking for more ways to tax us. There is actually a taxable impact to ISOs. It's part of the alternative minimum tax, and there's a reporting requirement for the company. Every January, you have to give your participants what's called a 3921 form. It gives them information about their ISO exercises in the prior years. And then by February 28th or March 31st, depending on if you're filing through mail or electronically, you actually have to file with the IRS that 3921 form. So if you haven't done that yet, there is a pretty heavy penalty. It's about, I don't know, I think it's $100 per exercise. It could be wrong, but it's a per exercise penalty. So hopefully you're on top of that, and you can still do your filing electronically if you need to do that. So getting into even another kind of complex area when it comes to equity is granting to international employees. We recommend, and I think every attorney we've worked with has recommended having a different grant agreement for different countries or regions to handle privacy laws, to handle tax laws. These days, every country seems to have different rules and regulations, even on acceptance. So, for example, the DocuSign thing that Amy talked about, you want to make sure that if you have international employees, that your legal team is comfortable, or the laws allow you to do that electronic signature, which I know 5.9 did that and looked into that before. The other thing is figuring out if you need local HR people on the ground in those countries, or how you're going to interact with those people and issue those grants. Education becomes a big piece of it. And I referenced some of the laws, but UK and China have some unique laws. In the UK, unless you have your employees explicitly accept that they're going to take tax responsibility, then the company actually has to pay the tax obligation. Excuse me, China, if you're a private company, you really can't be issuing grants in China, options I should say, unless they're tied to a liquidity event of some kind or vesting post-liquidity event. So you want to be careful with that. Most people have begun to realize that, but I know earlier when the SAFE laws came out, that was a new issue for people. And the last thing I'll mention is to know when to include outside professionals. There are experts in the laws of global equity We at Armanino don't claim to be those experts, but those are people that when push comes to shove, you don't want to be cheap in that area.
Scott, I agree with that. And access to local experts is definitely key. Many times there's additional filing or disclosure requirements that we're not aware of here in the States. I would also recommend that your stock team is in direct contact with the local HR or payroll team if there is one, just to be getting information timely instead of relying on HR sitting at your headquarters.
All right, so as the finance professional, you're responsible for recording at some point stock-based compensation related to these equity awards that have been given. One of the things you want to consider is the different classes of participants. Certainly for the two we've got listed here at the top, employees and non-employee directors. The amount of expense that is going to hit your P&L is effectively fixed on the date those awards are made, and then it's recorded as an expense over the vesting period. The difference there between those two groups and the non-employees, that the non-employees, you are going to continually mark those options to the market price of the stock and continually re-fair value those. And it results in an incremental expense versus a regular employee option. One of the reasons is simply because the term that you will use on those non-employee grants is effectively the full contractual term of the option agreement, which is 10 years. As opposed to employee options where you're assuming sort of a blend of the contractual period and the actual exercise or the presumed exercise period for those awards. So, again, most pre-IPO companies, you're not further dissecting that top two group of employees into different exercise behavior patterns or different assumptions used to generate those expenses. But as the company gets larger, as the desire is to reduce stock option expense, you may be forced into doing some different modeling and start dissecting employee behavior into different groups or categories of employees that could be, you could really create almost an infinite number of classes or categories as long as it's some objective framework. But typically what we've seen is a division between management, upper-level management of the company, and employees. That's typically the most common way that you would think about dissecting the stock option expense. And then this slide also just touches on some different things that you should be considering, just the forfeiture experience of those employee groups that you've designated. And then any modifications. I think some of the more common modifications we see is an extended time to exercise when folks are terminating from a company. So again, when you are going through the stock option expense on a quarterly basis and you've got your checklist, you should be sitting down with HR and saying, were there any modifications made to these awards, and start thinking about the expense impact of any of those modifications to the awards. And they're not always easy to uncover, especially when upper-level management and when it's a smaller company and there's more latitude, I would say, in what the key executives of the company are doing in terms of assisting employees that are going through either an exit with the company or maybe on leave for some period of time. So. Obviously, as this stuff gets farther in history, it becomes more difficult to dissect and determine what it is. So, as Scott said, you want to be thinking about this stuff well in advance of the IPO, so you're not there at the 11th hour with the auditors digging through old files trying to figure out what happened.
Yeah. Oh, sorry. Go ahead.
So, Matt, I think this slide, more than any other, really should be convincing to get yourselves on a system. When I started at Five9, everything was done on spreadsheets, and some of those formulas in those spreadsheets to handle some of these situations were unbelievable. And I have great comfort now that we're using software to handle some of these sticky, quote-unquote, situations.
Yeah, no, agreed. And unfortunately, we've done and are doing some spreadsheet calculations for some of our clients, and had a client the other day kind of ask the question of, can you simplify this formula for us? So definitely agree with that, Amy. The other thing I was going to mention is with the experience groups, don't overthink it. There's not necessarily a reason to dissect everything, but I will say with one caveat, the SEC and your auditors, definitely as you get closer to an IPO, do like or want an analysis on the forfeiture percentage. And typically they want to see a bifurcation between executives and rank and files, your executives having a very low or even no forfeiture rate applied to their awards versus your general population.
So this slide, we touch on some of the more significant financial statement disclosures. As you read through companies' footnotes, typically the footnote is going to be, upwards of 2, possibly 3 pages of disclosure related to the stock option plan. Some of that is boilerplate. The information that we have listed on this page, I think, is some of the more common option disclosures. But as you get into the more esoteric disclosures that are listed here on page 2, I think I would really question the FASB board and whether or not anybody reads through all of those disclosures. But again, as a company preparing for an IPO or even preparing for just normal audit procedure, what I'd suggest you do is get either the financial statement disclosure checklist or just print off the disclosure portion of ASC 718, which is the code that really speaks to how you should be expensing stock options. And again, when you're doing this in a pre-packaged software, most of the softwares have reporting components to them that will spit out all this information. But if you're trying to do this in Excel, I can guarantee you that at the 11th hour you're going to be pulling up the disclosure and saying, how the heck do I calculate this number? Because some of the numbers they call for are really not intuitive, and they're not necessarily something you would think that would be important to readers of financial statements. But nonetheless, your auditors are going to want you to prepare those numbers, and you should have some basis for showing them that you've got a full disclosure, because, again, as you're getting ready for IPO readiness, one of the things the auditors are going to focus on is controls, and if you don't have all of the required disclosures, then they may come back to you and say that's either a significant deficiency or a material weakness in the preparation of the financial statements. So you want to be sure. And again, it's very easy to get these, either a financial statement disclosure checklist from your auditors, or just go right to the code and look through the disclosure component of that.
Yeah, one thing I'll add, and we kind of noted here on the side, is even if you are using a system, you should know how to calculate or know how the system's calculating the numbers, because we always say the auditors aren't auditing the system, they're auditing your data. And one last thing I'll note, which is kind of one of those unique, maybe non-boilerplate disclosures. If you do have a material amount of consultants that have grants or expense, you may have to do some disclosures around those non-employees, which can sometimes be a little more difficult than your standard employees because of the mark-to-market aspect that Matt talked about.
Okay, so we're going to come up with our third polling question here. And as we are pulling this up, I want to just remind everyone that within 2 to 3 working days after the webinar, we will send you a link to the presentation slides, a recorded presentation, and then your certificate for completion for CE. So here's our third question. How early are you interacting with your auditor before audit fieldwork? 1 month, 2 months, throughout the year, or other? So I know that there's a preferred answer for this one that Scott and Matt will share with you, but we'd like to ask everyone to please put in their vote on this poll. And it looks like we're wrapping up. We'll give you about 10, 15 more seconds to get that one completed. And of course, also after the webinar, if you have any questions, we will be sharing with you Matt and Scott's email addresses, and so that you can ask them specific questions if we don't handle them today on the webinar. Okay, with that, we're going to go ahead and close the poll. And looks like there was a majority in one area there.
Answer C, which is the right answer. You should be consulting with your auditors continuously. Amy, what's been your experience here? Have you talked to the auditors frequently?
Definitely. They live in our offices actually right now. I think they've been there for the last 3 or 4 months. But certainly in preparation for year-end field work, we wanted them to pull their samples early so we could get a head start on all of that stuff as well. So the audit checklist slide that's actually up here right now is great, or will be up now.
That's okay.
And most of the time you're going to get this from your auditors anyways, but this is very comprehensive and is exactly the things that they're going to be asking for.
All right. And so this slide, again, is just what should I be gathering in anticipation of an IPO or an audit. And I would say even before that, when you identify a person in the finance organization and that person is responsible for stock options, you should, as that individual responsible, you should be pulling together all of these agreements. And one of the things listed here, employment contracts, may be something that in the finance organization is not necessarily going to be shared with you. You may need to sit down with human resources and say, okay, give me the specific piece of the employment contract that speaks just to the option awards. One of the things we touched on earlier was just option grants that were promised to an employee but then never made. If you read the actual technical rules on this under the ASC code, when there is a common understanding between the employer and the employee as to the number of options and the most substantive terms of those options, usually that's going to be the duration of the vesting and the strike price, then an option grant has effectively happened. So even though that thing never got papered, the company is responsible for recording the expense. And again, as we talked, if you're settling those up later with cash, then it's going to be a liability. So again, all good reasons that you should be creating or using this checklist and making sure that you're thinking about all of these documents and the potential impact that they would have on your stock option process and the ultimate expense that you're going to be recording to your P&L. So we'll flip through the next two slides here. They're just a bit more of an illustration of what was in that checklist. Again, we touched on 409A. It's certainly important to make sure you're doing those on a regular basis. Amy, do you have any input for us on the frequency of 409A in anticipation of an IPO? Did you start doing it more regularly?
We definitely did. We were doing quarterly during all of 2012. It was about semi-annual in 2011, and we started monthly as of October 2013. So in preparation for an IPO at some point this year, hopefully.
Yeah, and one of the data points that Scott and I worked on with a number of clients that are getting ready for an IPO is for those older periods when you might not have gotten a 409A that frequently. Maybe you're just getting it on an annual basis and you're doing all of the grants for that year based on the last 409A. That works fine from a corporate governance perspective, but then when you start talking about the stock option expense, all of a sudden you got to start really creating some assumptions that the auditors are then going to have to buy off on about what did the stock price do in the dates between the 409A valuations that you got. And again, it's just important to develop a methodology that sort of mirrors the performance of the company, but then get the auditors to buy off on that.
Yeah, just to add to that, I know we've seen more and more auditors and the SEC pushing for some sort of substantiation of value appreciation between valuation dates. And there's no rule of thumb whether that's 18 months, 2 years prior to the IPO, but some of the general guidance, and we actually talked about this in a webinar not too long ago with one of my valuation colleagues, but is not granting awards right before your next 409A, having that granting your awards as close, whether you're a year, 3 years, 4 years, even that far out from IPO, it's still there's some sort of value appreciation. And you don't want to be granting awards right before you're saying that value goes up, because you end up with potentially cheap stock, which from an accounting standpoint, it's not a huge risk. It's just more of a pain to manage and to expense, and your stock-based comp expense will go up pretty significantly as well.
So, the title of this reads Connect with the Auditors before the audit in the S-1. I think we talked about the importance of that. The valuation process, I think that is something that we haven't touched on. And I would throw the name of the valuation firm that you intend to hire to your auditors and let them vet whether or not they've heard of that firm. And if they haven't, then I think it would be a good idea to get that 409A, 90% done, kick it over to the valuation specialists within that firm. That's certainly what we do from an audit perspective. We ask our clients to make sure that before that report goes final, that our valuation team has looked at it and made sure that the folks doing the valuation are capable, and that the assumptions that are being used in there will stand up to muster both to the IRS and to the SEC. So I think we've touched on cheap stock charges and how to handle that. And then in terms of a new accounting policy, I would say an example there would be if a company is moving from straight line expense to an accelerated expense model, that's a change in accounting that you're going to want to walk through with your audit firm and make sure that if you're moving from one method to another, you either apply that retrospectively, or if you're doing it prospectively, that you can defend the change in accounting policy that it's preferable to the old policy. And that really is a big issue once you're getting on the IPO threshold, because the SEC is going to mandate that you're moving either towards a preferable treatment or that you restate prior periods. And certainly nobody wants to get into labeling financial statements restated that are going to be included in an S-1.
Yeah, not changing policies necessarily, but also if you're changing assumptions, you just want to be considerate of when you do that. Whether it's in a new year or potentially quarterly, but you just want to be considerate of the impact that has on your expense or your financial statements, and also that you can substantiate that change. Forfeiture rate is a big one. We often see that changed either quarterly or yearly. But if you've always done it yearly and then you all of a sudden decide to do it quarterly, there may be a valid reason for that, but you have to be able to substantiate that and quantify that reasoning.
Hey, Scott, Matt, I just have a couple other things related to the audit. Definitely, and I know we've said this before, stay on top of getting your signatures on your grant agreements. It makes a big difference. And as silly and basic as this sounds, make sure that when you're recording your exercises, that the entries you're booking to Common Stock and APIC all tie out and make sense. So in prior years, that wasn't necessarily the case for us, and when the auditors find those things, you don't look very good. So they like it when everything ticked and ties.
I think actually on the exercise point too is, the other thing is on withholding, right? The auditors are going to look at those, whether you're properly calculating the withholdings, and if not, then you may end up with a tax liability.
Definitely.
So we're going to touch on M&A considerations, and again, we're talking about it very much from a stock option or an equity perspective only. And from administratively, some of the things to consider or to think about, and maybe before, or maybe the transaction's already happened, but now you have to figure out how to get this into your new system or get new grant agreements to your participants. Have you assumed the prior stock option plan or equity plan, or are you simply just granting all of the acquired employees stock options or equity under your new plan? So administratively, right, it makes a difference of how you're going to paper those agreements, or if you're not going to paper them and the old paper applies. Some of the other things we've come across where companies may not have designated that their grants were ISOs. And typically, kind of the rule of thumb, and there could be other facts to substantiate otherwise, but the rule of thumb is typically if it's not explicitly stated as an ISO, it defaults to a non-qual. Obviously, you want to get legal, but that impacts tax, that impacts your participants as well. You want to be cognizant of change of control provisions and how those play out in the new equity awards post-acquisition, or maybe in the equity awards at the transaction date. Documenting new awards, and we've gone through this with a number of clients who they haven't assumed the plan, but now they're issuing grants out of their plan, but they are using the original strike price, which is allowed. The IRS allows you to modify that in transaction-related instances, but you just want to be cognizant of that and how you're going to grant that, and also how your system's going to handle that as well. And I think a big piece is employee education, right? Making sure your employees understand what